A lot of people might be wondering why I still continue to be bearish. This has been a tremendous rally in the market. The QQQ is at new 52-week highs. Apple's at new 52-week highs. Why don't I just make life easy and go and buy some Apple and know that in 5 years' time, nothing too crazy is going to happen to me? The reason why I can't do that at this time is because I believe the hard part is only just beginning. What do I mean by the hard part? What I mean by the hard part is the actual economic slowdown and the real estate portion of the economic slowdown. Let's not forget, commercial real estate prices just declined for the first time in over 12 years. That is the headline that is coming out recently. First time. It didn't do that last year. Also, what didn't happen last year was a consumer slowdown. I just got a notification on my phone 2 days ago or on Snapchat specifically, about a photo I posted on my Snapchat story that was a quote from the Target CEO that said no signs of a consumer slowdown. That is very different than what we heard at the last earnings conference call just earlier this week. Very strangely, that stock was up and down, but finished the day up after that earnings call. And then the next day was down over 4%, that being yesterday. But that's besides the point. My main point here is last year, they said no signs of a consumer slowdown. This week, they said April was weaker than March and May is weaker than April. And they're likely to see that continue. We see what's happening with Foot Locker. That stock's down some 25%. Consumer slowdown. The consumer is the economy. That's what the whole thing is. Apple phone sales are down in the United States because of the consumer. It's important. Additionally, it's not just the consumer areas of the economy. Areas of the economy that experienced a boom in past years, which is virtually all of them, when interest rates were low, financing was easy to obtain, and there was a lot of stimulus and a lot of spending, just general economic growth. We had a full-on boom. It could have been the biggest boom of all time. John Deere, farming equipment, they beat earnings expectations, were up 5% pre-market, just as the market was going to open. And then on the earnings call, the CEO provides his guidance and says prices are going down and demand is going down. And boom, the stock went from up 5% to down over 1%, a 6% or so move after beating earnings. Why? Because of what is ahead of us. And the market, in my opinion, is just going back to old prices, is not looking at the future, because the future is simply not good. Why is it not good? It's not good because, one, the Federal Reserve is shredding money. That affects everything. Two, the Fed has increased interest rates. We know interest rates operate with the lag. So we ain't seen nothing yet. They're still hiking. These hikes are going to take time to work through the economy. And according to the Fed, inflation is not moving down as quickly as they would like. And we can see that in core CPI, when you just strip out the very volatile categories, food and energy, of which I feel very good about oil and gas going back up, given that rig counts are down a lot. Biggest rig count decline since September 21, today announced. And OPEC is saying they're going to stick to their cuts. And Bank of America is saying they might cut again. So, I think oil is going to be fine. So just totally forget CPI. Just throw CPI out of the water and it becomes clear that inflation is not coming down. And that is totally fine and totally expected because they printed so much money and they haven't deleted that money. It's still working its way through things. Now, it's going to get back down to 2%. I'm confident of that. But the Fed isn't sure if it's that sufficiently restrictive. It seems like there's more Fed members than not that either don't think they're at sufficiently restrictive levels or feel that inflation is not coming down as fast as they would like. And they can't afford to mess us up. They can't afford to mess us up. So the Fed is probably going to keep its foot on the brake of the economy. And if they need to keep pushing it, they're going to keep pushing it. And so far, it's not moving the way they would like. It's simply not. But we're starting to see signs of crack. And these are signs that despite the 27% decline in the markets we saw last year, or thereabouts, 27%, we did not see these things. In May of last year, we had Target saying no signs of consumer slowdown. Even this quarter, for a lot of companies, earnings were down, but they were still pretty strong, slightly better than expected. That might be good enough for like a little bit of gain, but the amount we've done based on that notion has been crazy because it's not fully considering that this is the beginning of a bigger pullback. This is the early stages. This is the just beginning to feel the effects of rate cuts or rate hikes. We're just beginning to see commercial real estate tick down for the first time in 12 years. Just starting. And nobody has been using office space like the way that they were in the past. Like, think about that. I believe it's either like last month in April or something, or maybe last quarter, but probably April. Let's call it April. It's a recent thing. It's like this year it occurred. April, first month of commercial, because it's hard to track these prices. It's not a very liquid market. Commercial real estate prices have fallen for the first time in 12 years. For all the rises in interest rates, for all the rhetoric around commercial real estate, the fact that we're just starting to move off the peak in that area of the economy, I mean, come on. We think it's over already? I don't think it's over. I think it's going to be a big deal. Additionally, I don't think the banking stress is over. Janet Yellen said there might need to be some more bank mergers. Well, there might need to be some more bank mergers. What is that code name for? That's code name for some more bank failures. And it could get sloppy. This is not an area I think is super important, but it could be important now as we focus on the other side of inflation coming down, which is the economy slowing and the economy coming down. JP Morgan said they don't want to do any more bank mergers. So, well, it'll be interesting when that next bank fails. That's for sure. That's for sure. Anyways, why am I continuing to be bearish on this market? Because I think the economy is only just beginning to tip over. And I think it's going to be different than it was last year big time. And last year was enough to scare people. Interest rates have gone higher than people thought at the end of last year. And they're still going to go higher again. It seems like 5.25 to 5.5 is where this rate is going to end up. At a minimum, assuming then that core inflation begins to start breaking 5%, which it probably will, simply based on the base effects of the math. But they need to start seeing a more extreme slope. And that extreme slope is only going to occur if the economy actually weakens. I'm trying to pull up, the 2-year, for example, versus where it's been. These are rates that just simply have not been seen in a very long time. So to just go back to past prices in NVIDIA, in Apple, in Microsoft, etc., I get it. These are good businesses. Hey, I've been saying that the whole time. I record all these videos on Apple products. I'm currently holding an Apple iPad. I also have a MacBook Air, both on this desk. I'm not stupid. I get it. Apple products are good, okay? I get it. Anyways, but yeah, the 2-year, before the banking crisis, it was at the highest in 5 years. And really the highest since right before the great financial crisis. The Fed was hiking rates prior to the great financial crisis to try and tamp down the excessive speculation and the overheating economy out of fears that inflation might occur. So, I'm bearish. I hope this provided you with a more high-level view of things. Feel free to ask any questions you might have. It's been a difficult market. It's been a crazy market. We'll see what happens. That's today's video, and until next time, peace out.